This is one of the ways that sophisticated investors are able to make money in a bear market. It's called a dual directional note. They're issued by all the major banks out there, Goldman Sachs, Morgan Stanley, Barclays, banks that you've heard of. And it's really a package of options and derivatives where the bank is taking on the risk of the option strategies and thus guaranteeing the investors a particular outcome. An example might be this: a note for the next 4 years tied to the S&P 500, where if the S&P 500 is higher at maturity of the note, the investor gets a leverage return. All notes are different. It could be 110 to 180% leverage. So uncapped upside that outperforms the S&P for the time period. The important part of this, though, is the dual directional component. Each note is going to have what's called a barrier or a buffer. Let's say it's a 30% barrier. What that means is that at maturity, if the S&P 500 is lower than it was on the trade date of the note, between -1 and -30%, the investor actually receives the inverse positive return. So -11% would mean investor receives +11. But if the index is down more than that barrier, let's say down 31%, now the investor is participating in the losses of that index. So a -35% index at maturity would result in 35% loss of principal to the investor.